The first chart immediately highlights how differently each group of economies is performing. Vietnam remains the fastest growing economy in the region, maintaining quarterly GDP growth above 8% across the last 4 quarters. That consistency reflects the country's increasingly important role in global electronics manufacturing and semiconductor supply chains. Rather than simply serving as a low-cost assembly hub, Vietnam continues moving up the manufacturing value chain, attracting additional foreign direct investment as multinational firms diversify production. China also maintains remarkably stable growth around 5%, while concerns surrounding property markets and demographics remain. Advanced manufacturing, exports, and government support for strategic industries continue providing an important economic cushion. The economy is increasingly relying on industrial upgrading rather than real estate to sustain expansion. Japan presents an interesting contrast. Growth has improved significantly compared with previous years as exports strengthen and corporate investment accelerates. Although quarterly growth remains lower than many regional peers, Japan's recovery reflects improving industrial activity and the gradual normalization of domestic demand. South Korea experienced more volatility during the period, but its longer-term outlook remains closely tied to semiconductor demand. As memory chip exports continue benefiting from the AI investment cycle, growth should stabilize further. Turning to the resource-based economies, Indonesia continues posting resilient growth around 5% despite global uncertainty. Domestic consumption remains relatively healthy, while commodity exports provide an additional source of support. Australia has also maintained relatively strong growth, although the pace has moderated slightly as higher interest rates weigh on household spending. Elevated commodity prices are supporting national income, but tighter monetary policy continues limiting domestic demand. New Zealand remains the weakest performer among the resource exporters. After periods of sluggish activity and even mild contraction, the economy is only gradually recovering as external demand improves. Finally, the service-oriented economies present a mixed picture. Singapore remains one of the strongest performers thanks to its diversified economy, where financial services increasingly complement booming electronics exports. The Philippines has steadily accelerated throughout the period, reflecting resilient domestic demand despite inflationary pressures. Thailand's growth remains relatively moderate, illustrating the challenges faced by tourism-dependent economies as international travel softens. Malaysia continues expanding at a respectable pace, although growth has eased somewhat compared with earlier quarters. Taken together, this chart tells a very important story. The region is no longer moving together. Manufacturing economies connected to AI investment are generally outperforming. Resource exporters remain supported by commodities, while service-led economies face a much more challenging environment. The first chart immediately highlights how differently each group of economies is performing. Vietnam remains the fastest growing economy in the region, maintaining quarterly GDP growth above 8% across the last 4 quarters. That consistency reflects the country's increasingly important role in global electronics manufacturing and semiconductor supply chains. Rather than simply serving as a low-cost assembly hub, Vietnam continues moving up the manufacturing value chain, attracting additional foreign direct investment as multinational firms diversify production. China also maintains remarkably stable growth around 5%, while concerns surrounding property markets and demographics remain. Advanced manufacturing, exports, and government support for strategic industries continue providing an important economic cushion. The economy is increasingly relying on industrial upgrading rather than real estate to sustain expansion. Japan presents an interesting contrast. Growth has improved significantly compared with previous years as exports strengthen and corporate investment accelerates. Although quarterly growth remains lower than many regional peers, Japan's recovery reflects improving industrial activity and the gradual normalization of domestic demand. South Korea experienced more volatility during the period, but its longer-term outlook remains closely tied to semiconductor demand. As memory chip exports continue benefiting from the AI investment cycle, growth should stabilize further. Turning to the resource-based economies, Indonesia continues posting resilient growth around 5% despite global uncertainty. Domestic consumption remains relatively healthy, while commodity exports provide an additional source of support. Australia has also maintained relatively strong growth, although the pace has moderated slightly as higher interest rates weigh on household spending. Elevated commodity prices are supporting national income, but tighter monetary policy continues limiting domestic demand. New Zealand remains the weakest performer among the resource exporters. After periods of sluggish activity and even mild contraction, the economy is only gradually recovering as external demand improves. Finally, the service-oriented economies present a mixed picture. Singapore remains one of the strongest performers thanks to its diversified economy, where financial services increasingly complement booming electronics exports. The Philippines has steadily accelerated throughout the period, reflecting resilient domestic demand despite inflationary pressures. Thailand's growth remains relatively moderate, illustrating the challenges faced by tourism-dependent economies as international travel softens. Malaysia continues expanding at a respectable pace, although growth has eased somewhat compared with earlier quarters. Taken together, this chart tells a very important story. The region is no longer moving together. Manufacturing economies connected to AI investment are generally outperforming. Resource exporters remain supported by commodities, while service-led economies face a much more challenging environment. The divergence becomes even clearer when we examine export performance. Vietnam continues to lead the group with export growth, consistently reaching impressive double-digit rates. This reflects not only stronger global demand for electronics, but also Vietnam's growing importance within multinational supply chains. As production shifts toward Southeast Asia, Vietnam has become a critical manufacturing base for global technology companies. China's exports also remain resilient despite geopolitical tensions. Although trade restrictions continue making headlines, China's manufacturing ecosystem remains extraordinarily difficult to replace. The country's advanced industrial base allows exporters to continue benefiting from robust demand for machinery, electronics, and increasingly AI-related hardware. Japan demonstrates a much steadier trajectory. Export growth has improved gradually, supported by industrial machinery, semiconductor equipment, and precision manufacturing. Rather than experiencing explosive gains, Japan benefits from stable demand, across multiple high-value industries. Perhaps the most dramatic acceleration belongs to South Korea. Export growth surged sharply during late 2025 and into 2026, largely driven by extraordinary global demand for memory chips and AI-related semiconductors. Companies such as Samsung Electronics and SK Hynix remain central suppliers to the global AI infrastructure build-out. An effective way to think about this trend is to imagine constructing an entirely new digital highway. Artificial intelligence requires enormous investments not only in software, but also in chips, servers, networking equipment, memory, and data centers. Every new AI model requires vast amounts of physical infrastructure, and these four manufacturing economies supply many of the critical components needed to build that infrastructure. This explains why manufacturing-led economies continue separating themselves from the rest of the region. Looking beneath the headline, export numbers provides even greater insight into what is actually driving this manufacturing boom. China's high-tech product exports have continued trending higher throughout the period. Rather than relying on traditional manufacturing alone, China is increasingly exporting higher value products that benefit from industrial upgrading and technological investment. Japan's semiconductor exports also continue strengthening. Japanese firms occupy critical positions within the semiconductor ecosystem, supplying advanced manufacturing equipment, specialty chemicals, and precision industrial machinery. Every expansion in semiconductor production creates additional demand for Japanese technology. Vietnam's electronic component exports remain exceptionally strong. Although monthly fluctuations occur, the longer-term trend clearly points upward as multinational firms continue expanding production capacity throughout the country. The most striking chart belongs to South Korea. Semiconductor exports have surged dramatically, reflecting explosive demand for advanced memory chips. AI training systems require enormous quantities of high-bandwidth memory, giving Korean manufacturers an increasingly valuable competitive advantage. Unlike previous technology cycles driven by consumer electronics, today's AI investment boom requires simultaneous investment across multiple layers of hardware. Data centers need processors, memory, networking equipment, cooling systems, advanced packaging, and industrial automation all at once. That broader investment cycle makes the current expansion much more durable than traditional semiconductor cycles, supporting manufacturing growth across Northeast Asia for longer than many investors initially expected. Shifting our attention to the resource exporting economies, the picture looks noticeably different from the manufacturing leaders. During the first quarter of 2026, exports from Indonesia, Australia, and New Zealand remained relatively subdued. But beginning in April, all three economies experienced a meaningful rebound. Importantly, this improvement was not driven by a sudden surge in global demand. Instead, it reflected higher commodity prices following escalating geopolitical tensions in the Middle East. Indonesia benefited from stronger prices for coal, palm oil, and other natural resources. Export revenues improved quickly, providing additional support for government finances and domestic investment. At the same time, infrastructure spending and resilient household consumption helped cushion the broader economy against external uncertainty. Australia experienced a similar pattern. Higher energy prices lifted export income, particularly through coal and liquefied natural gas. Yet the stronger external sector also came with a trade-off. Elevated commodity prices fed into inflation, prompting the Reserve Bank of Australia to maintain a more restrictive monetary stance. While exporters enjoyed stronger revenues, higher borrowing costs continued weighing on consumers and the housing market. New Zealand's recovery was more gradual. Unlike Australia and Indonesia, its export basket relies more heavily on agricultural products, particularly dairy. Agricultural prices respond to different supply and demand dynamics than energy markets, limiting the immediate benefits from geopolitical disruptions. This illustrates an important distinction between the current commodity cycle and previous ones. During earlier commodity supercycles, prices rose because global demand expanded rapidly. Today, many commodity prices are increasing because supply has become constrained. Exporters receive higher prices, but shipment volumes often remain relatively unchanged. That means stronger revenues do not necessarily translate into equally strong economic growth. This relationship becomes even clearer when we examine the underlying commodity markets themselves. Beginning around March, several major commodities turned sharply higher. Coal prices recovered significantly, benefiting both Indonesia and Australia. Coal remains a vital energy source across much of Asia, despite the long-term transition toward cleaner energy. Supply disruptions, combined with elevated electricity demand, helped push prices higher. Palm oil also experienced a powerful rally. Indonesia, as the world's largest palm oil exporter, stands to benefit directly from these higher prices. Rising export revenues improve trade balances and strengthen government fiscal positions. Iron ore, by comparison, remained considerably more stable. While fluctuations continued throughout the year, prices avoided the dramatic swings seen during previous commodity cycles. China's infrastructure investment and manufacturing activity continued providing a relatively stable source of demand. Natural gas prices also stabilized after earlier volatility, providing some support for New Zealand's energy sector, while helping moderate inflation pressures, compared with the sharp spikes experienced in earlier years. For investors, the key takeaway is that resource exporting economies continue to enjoy favorable pricing conditions. However, higher commodity prices are increasingly accompanied by tighter monetary policy. Stronger export income supports corporate earnings, but higher interest rates limit domestic consumption and private investment. Unlike manufacturing economies, where AI investment creates both stronger exports and stronger capital expenditure, resource exporters face a more balanced outlook, with positive external conditions offset by tighter financial conditions. The contrast becomes even more striking when we examine tourism-dependent economies. Before the pandemic, Thailand, Malaysia, Singapore, and the Philippines all relied heavily on international visitors to support economic growth. Tourist arrivals collapsed during COVID-19 before recovering steadily over the following years. However, after March 2026, that recovery began losing momentum. Thailand experienced one of the most noticeable slowdowns. As one of the world's premier tourism destinations, Thailand remains particularly sensitive to global travel demand. Higher airfares, geopolitical uncertainty, and weaker consumer confidence internationally have all contributed to softer visitor arrivals. Malaysia also experienced moderation after a strong recovery period. While tourism remains important, Malaysia benefits from greater diversification through electronics manufacturing, helping offset some of the weakness in travel-related sectors. Singapore's visitor numbers softened as well. Yet, unlike many tourism dependent economies, Singapore's economy relies heavily on financial services, logistics, and advanced manufacturing. This diversification allows the country to weather temporary weakness in tourism far more effectively. The Philippines continues recording the lowest tourist arrivals among the four economies. Domestic demand remains the primary driver of growth, but higher imported energy costs and persistent inflation continue pressuring household spending. Tourism behaves much like consumer confidence. When geopolitical uncertainty rises and transportation costs increase, international travel is often among the first categories where households reduce spending. That explains why service-oriented economies have generally underperformed manufacturing economies during the first half of 2026. Exports among the service-oriented economies tell a somewhat more encouraging story. Malaysia's exports have strengthened considerably in recent months, supported by its deep integration into global semiconductor and electronics supply chains. While often grouped alongside service economies, Malaysia increasingly resembles a hybrid economy that benefits from both manufacturing and services. Singapore's non-oil domestic exports also rebounded strongly after periods of volatility. Electronics remain a major contributor, with semiconductor-related exports benefiting directly from the global AI investment cycle. Thailand has experienced a more uneven export recovery. Manufacturing continues improving gradually, but slower tourism activity and softer domestic demand limit overall economic momentum. The Philippines displays the greatest volatility among the four economies. Export growth has fluctuated significantly from month to month, reflecting changing demand across electronics, business process outsourcing, and global trade conditions. The broader message is that not all service-oriented economies are equally exposed to current global trends. Singapore and Malaysia have successfully diversified beyond tourism by developing sophisticated manufacturing ecosystems closely connected to global technology supply chains. Thailand and the Philippines remain more dependent on domestic consumption and tourism, making them more vulnerable to slower global travel demand and higher energy prices. This divergence reinforces one of the central themes of this presentation. Industrial positioning now matters more than geography. Countries integrated into AI-related manufacturing continue outperforming those relying primarily on traditional service industries. Now we arrive at what is arguably the most important chart in this entire presentation. If there is one structural force separating the winners from the laggards across the RCEP region, it is artificial intelligence. This chart compares AI-related exports from China, Japan, South Korea, and Vietnam against two broader global indicators: worldwide semiconductor shipments and the global manufacturing PMI. Together, they tell a remarkably consistent story. Despite concerns that the AI boom may be nearing its peak, both semiconductor shipments and manufacturing activity remain firmly in expansion territory. More importantly, exports from the region's major manufacturing economies continue trending higher alongside these indicators. South Korea remains the standout performer. Semiconductor exports have accelerated dramatically as demand for high bandwidth memory continues to exceed supply. Every large AI model requires enormous amounts of memory, and Korean producers remain global leaders in this critical technology. Japan is benefiting through a different channel. Rather than manufacturing the majority of chips themselves, Japanese companies provide the specialized equipment, industrial robots, and advanced materials that enable semiconductor production around the world. As long as new fabrication plants continue to be built, Japan remains an essential part of the value chain. China continues expanding exports of high tech manufactured products despite ongoing geopolitical restrictions. Government investment in advanced manufacturing and industrial upgrading has helped maintain competitiveness in sectors that remain strategically important. Vietnam continues moving higher up the technology ladder. Instead of competing solely on labor costs, the country is steadily expanding into semiconductor packaging, electronics manufacturing, and precision engineering, attracting additional foreign direct investment in the process. The important point is that today's technology cycle differs fundamentally from previous ones. Earlier semiconductor booms were driven largely by consumer demand for smartphones or personal computers. Those cycles eventually slowed once consumers finished upgrading their devices. Today's AI cycle is different because it represents an infrastructure investment boom. Companies are not simply purchasing software, they are building entirely new computing infrastructure consisting of data centers, networking equipment, advanced processors, cooling systems, memory, and power management. That broader investment cycle creates a much longer runway for manufacturing activity than previous technology expansions. For investors, this remains the single strongest structural growth theme across Asia. The first half of 2026 has demonstrated that the RCEP region is entering a new phase of economic divergence. Trade disputes may still influence headlines, but they are no longer the dominant force shaping investment returns. Artificial intelligence, geopolitical realignment, and commodity markets have become the primary drivers separating winners from laggards. Manufacturing economies remain the biggest beneficiaries of the global AI investment cycle. Resource exporters continue enjoying stronger commodity prices, although tighter. Monetary policy introduces new challenges. Service-oriented economies face a slower path forward as tourism recovery moderates and domestic demand remains under pressure. For investors, the message is increasingly clear. Rather than viewing Asia as a single investment story, the region should be understood through its structural economic positioning. The countries building tomorrow's digital infrastructure are likely to remain the strongest long-term beneficiaries of this new investment cycle. As always, we'll continue monitoring the data, identifying the structural trends behind the headlines, and helping investors navigate an increasingly complex global economy. Thank you for watching.